Hey everyone, welcome back to Corporate Decoder, the place where we decode those dusty corporate filings to find the hidden treasures, or sometimes the hidden landmines. Today we are looking at something that might seem like just another piece of paper, but it's actually a story about how a company is cleaning up its act, or at least its stock structure. Alright, so this is a Form 8K, which is basically a report for big, important, often unexpected events that a company needs to tell its investors about right away. Think of it like a news alert for the stock market. This report is from Pharmaceuticals Inc., a company that makes drugs. They've been around for a while, and like many companies, they sometimes do deals that make their finances and stock a bit complicated. The big news dropped on the 26th of September 2025. Now, what happened that was so important it needed an immediate report? It's all about a special type of stock they issued a few years back, called Series A Convertible Preferred Stock. Back in November 2021, Pharmaceuticals sold 25,000 of these special preferred shares to a company called Ampersand. They paid a hefty sum for these $1,000 for each share, totaling a cool $25 million. So, what makes this preferred stock so special? Well, it had a few perks. It paid a yearly dividend of 6.5%, which could be paid in cash or in more stock. And importantly, these shares could be converted into regular common stock, the kind most people own. Now, part of this deal allowed Ampersand to convert these preferred shares into common stock. On the 14th of August of 2025, Ampersand decided to convert 5,000 of their preferred shares. This turned those preferred shares into over 120,000 common shares. This means that for every preferred share they converted, they got a bunch of common shares back. This conversion happened based on a set price, which was about $41.47 for each common share. But here is where the real action is. On the 26th of September, the very date of this report, Pharmaceuticals itself forced the conversion of the rest of those preferred shares. That's 20,000 shares, which became another 482,000 common shares. This is called a mandatory conversion. It happened because the company common stock price had reached a certain level for a specific number of days. Basically, the company stock had performed well enough that the preferred shares had to be converted into common shares. What this means is that all 25,000 of those series of preferred shares are now gone. They have all been converted into a total of over 600,000 common shares. From the company's perspective, this is great. It cleans up their balance sheet by getting rid of this special stock. It can simplify their ownership structure, potentially making it easier for them to raise money in the future, or just operate without the complexities of preferred stock terms. The company is also stating that these newly issued common shares were done without needing to go through a full registration process with the SEC. They are relying on an exemption because this was essentially an exchange with an existing shareholder, Ampersand, and they did not pay anyone to convince Ampersand to make this exchange. It is a technical detail, but it shows they are following the rules for how they issue stock. And who is signing off on this? It is Stephen P. Carey, the Senior Vice President of Finance and Chief Financial Officer. He is confirming that all this has been done according to the rules. So let's look at the big picture here. This filing is all about bringing order to Pharmaceuticals' capital structure. They issued preferred stock a few years ago as part of an acquisition. This stock had investor-friendly features, including conversion rights, and also company-driven conversion triggers based on stock performance. It looks like the company has been performing well, with its common stock price rising enough to trigger the mandatory conversion. This is a positive sign. It means the company's value has increased, making the preferred stock conversion into common stock more beneficial for the company and its existing shareholders, as it simplifies things and removes a layer of complex securities. While the specifics of the conversion price and the number of shares are technical, the underlying story is one of growth and simplification for Pharmaceuticals. They are moving from a more complicated financial setup to a cleaner one, which is generally seen as a good thing for a growing company. It signals confidence in their future prospects because they are essentially betting that the common stock will continue to be valuable. There aren't major risks explicitly called out in this particular report regarding this conversion, but anytime a company enters into complex financial agreements, there is always a chance of unforeseen consequences down the line, though this specific event seems very straightforward. Alright, that is our breakdown of Pharmaceuticals' latest filing. What is your take on this stock conversion and what it signals for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.